The silent casualty of war, protecting your wealth. In every war in history, there have been two types of casualties. The first is splashed across the headlines. The second, no one talks about. It quietly empties people's pockets. It silently destroys the savings, retirements, and financial futures of millions of ordinary people who have never even held a weapon. We watch the news, we see the maps, we feel the anxiety, but there is something almost no one talks about. When geopolitical crises break out, your bank account, your savings, and the purchasing power of your money are also on the front lines. Inflation doesn't wait for peace treaties. The depreciation of your money doesn't pause while diplomats negotiate. And historically, under the extraordinary financial pressure created by war, governments have done things that would be unthinkable during peacetime. Freezing accounts, implementing capital controls, seizing assets, and printing money at a speed that turns savings into worthless paper. This video is not intended to create fear. We aren't here to cause panic. We are here because the most dangerous thing you can do in uncertain times is to do nothing. Today, we are talking about what history truly teaches us and what smart, prepared people do with that knowledge. The principle is simple. We act with information, not fear. Chapter 1. Historical lesson. How war economies actually work. Now let's go back to the past, because history is the only honest financial advisor we have. During World War I, all major European powers abandoned the gold standard almost overnight. Why? Because war is expensive, astronomically expensive. Governments needed to finance armies, weapons, logistics, and debts. And the fastest tool they had was the printing press itself. Germany is the most extreme example of this. By 1923, after years of war debt and reparations, the German currency, the mark, had collapsed so completely that people were literally carrying wheelbarrows of money to buy a loaf of bread. A single American dollar, yes, you heard that right, just $1, could buy over 4 trillion marks. The savings of an entire generation vanished, not by bombs, but by inflation. But this wasn't unique to Germany. In post-World War II Hungary, inflation reached figures that would overshadow Germany. It even reached a point where, at its peak, prices doubled every 15 hours. More recently, similar dynamics occurred in Yugoslavia during the conflict of the 1990s, in Zimbabwe in the 2000s, and in Venezuela over the last decade. The mechanism is always the same. War leads to massive public spending, leads to issuance of bonds that no one wants to buy, leads to the central bank monetizing the debt, leads to explosion of the money supply, leads to collapse of purchasing power. And here is the point most people miss. This doesn't just happen in countries actively at war. Neighboring economies, major trading partners, and countries with linked currencies also feel the tremors. In a globally interconnected financial system, a war anywhere can devalue currencies and fuel inflation everywhere. So the real question for us, for you and me sitting here right now, is this: what do the people who survive these periods economically have in common? What did they do that others didn't? Chapter 2. Asset Protection Strategy. Defense. Most people's first instinct is to hold cash, and cash has a role, but you need to understand its limitations during a crisis. The bank risk. No one tells you. Under financial stress during wartime, governments implement capital control, restricting how much money you can withdraw, whether you can make international transfers or convert it into foreign currency. In 2013, banks in Cyprus were closed for 2 weeks, and withdrawals were limited. During the 2015 Greek crisis, daily ATM withdrawals were capped at 60 euros. This isn't paranoia. This is a documented and recent reality. In a true war scenario, these restrictions become much faster and much harsher. Safe haven currencies. Not all cash is equal. If we are going to hold cash, the question is, which cash? Historically, 3 currencies have maintained safe haven status during global turmoil: the US dollar, USD, the Swiss franc, CHF, and, to a lesser extent, the Japanese yen, JPY. These currencies are backed by deep and liquid markets, strong institutions, and, in the case of Switzerland, a century-old tradition of political neutrality. A reasonable approach suggested by many financial planners for crisis preparation, not as investment advice, but as an emergency framework, is to keep the equivalent of 3 to 6 months of your essential expenses in an accessible and liquid form. Evaluating a portion of this amount in diversified hard currencies is a sensible option. Geographic diversification. The families and individuals who were able to bring any wealth intact out of the great European conflicts of the 20th century were, almost without exception, those who kept their assets in multiple countries. Swiss bank accounts, real estate in neutral countries, assets that couldn't be seized by a single government decree. Today, geographic diversification is more accessible than ever through international brokerage accounts, foreign real estate, or simply savings held in institutions across multiple countries. Chapter 3. Assets that historically appreciate during wartime. Important warning, nothing in this section or this video constitutes financial or investment advice. We are analyzing historical patterns for educational purposes only. Always consult a qualified financial advisor before making any investment decisions. Now that we've cleared that up, let's talk about what history shows us. Gold and silver, the oldest safe havens. Gold has been used as a store of value for over 5,000 years, and there's a reason for it. It cannot be printed. It cannot be melted away by inflation. It has no counterparty risk. It doesn't need a government, a bank, or a company to maintain its value. Those who held gold during World War II protected their purchasing power even through the most dramatic economic collapses in history. In the 2008 financial crisis, gold rose while stock markets fell. During the 2020 COVID shock, gold reached all-time highs. In 2022, with the escalation of the Russia-Ukraine conflict, gold spiked again within weeks. Commodities, energy and agriculture. War disrupts supply chains, period. And when supply chains break, commodity prices rise because it becomes difficult to transport, produce, and deliver the physical goods people need. Energy is the most obvious example. Oil and gas prices rose dramatically following the 1973 Arab oil embargo, the Gulf War, the invasion of Iraq, and the Russia-Ukraine war. Agricultural commodities follow a similar logic. Russia and Ukraine account for about 1/3 of global wheat exports. When this conflict broke out in 2022, wheat futures contracts increased by over 50% in a matter of weeks. Stocks, a selective approach, not general. Not all stocks suffer during wartime. Some sectors have historically shown striking rallies. Defense and aerospace, military spending skyrockets. Order books of companies producing defense systems and military logistics fill up instantly. Energy sector. As prices rise, these companies often experience significant revenue growth. Consumer staples. People still need food, medicine, and basic household products. These are much more resilient than luxury brands. Real estate. Location is everything. Real estate in a war zone can go to zero, not just in value, but physically. On the other hand, real estate in stable and geographically distant regions, especially farmland, has historically been a powerful tool for preserving wealth. Farmland is productive, provides returns independent of currency regimes, and is difficult to seize remotely. Cryptocurrencies, the new variable. The argument for Bitcoin's rise is compelling. It is borderless, permissionless, and cannot be inflated by any government. During the Russia-Ukraine war, both sides turned to crypto for financial transfers when traditional banking became difficult. However, crypto continues to show a high correlation with risk assets during sudden panic phases, often falling sharply before potentially recovering. Chapter 4. Action Plan. What should you do starting today? Let's turn all of this into something practical, because knowledge that doesn't turn into action is just anxiety expressed with better words. Assess your exposure. Where is your wealth right now? How much of it is in a single bank, currency, or country? Build accessible liquidity. Keep 3 to 6 months of expenses in a liquid form. Don't stay locked into a single institution. Allocate a portion to hard assets. This doesn't have to be dramatic. A modest share in physical or digital precious metals can act as a crisis buffer. Diversify geographically. Use international brokerage accounts or foreign ETFs to protect against single country risk. Closing. The main message. The survivors of financial crises are not the smartest, the richest, or the luckiest. They are the most prepared. They thought about it before the crisis broke out. They diversified before they needed to. We live in a world where geopolitical risk has reached levels not seen in decades. This is not a reason for despair. It is a reason for preparation. As geopolitical headlines darken, the rat race doesn't end. It intensifies if we don't take control. So, how are you preparing? Write your thoughts in the comments. If this video gave you something truly useful, please subscribe. We publish content every week on financial independence and escaping the rat race. Remember, the goal was never to be the richest person in the room. The goal is to still be standing when the storm passes. Stay prepared. Keep your wits about you. See you in the next video.